Well, it might not seem like it now, but opportunity does await. And that's based off of seasonality. The only rocket ship we're seeing so far in the start of March is, well, looking at the VIX having a new yearly closing high that we actually haven't seen, well, I guess since all the way back to 2021 in January, we haven't closed that high. And on top of that, we have oil just blasting off like a rocket ship among other commodities. So question is this going to continue, or are we going to finally see this kind of take a little bit of a breather? Well, I'll tell you what's going to put stress on the market if we start getting back above those 2014 highs and oil continues to press up of those levels. And you can see we're butting right into that area of resistance right now. You're watching the Stock Market Brief Show. I'm Michael Silva. We got a lot of charts to go over in today's video. We're going to go into the risk ranges and even the 15-minute time frames as well for the indices to look over some opportunities that I do see. Got a lot to talk about. Let's hop into the show. All right, everybody, welcome back. So when I started off this, I said opportunity awaits, although it may not feel like it right now. I wanted to point out a seasonality chart. This is based off of a 20-year range ending December 31st of 2021. And I wanted to call this out because we talked about seasonality in the earlier part of the year and even coming into 2022, that it can be a little bit rough. But we are coming into a quarter end here very soon. And a lot of things happen during quarter end, such as rebalancing. And I want to point this out that in March and April, based off of seasonality, those are some of our, that looks like a horrible drawing. Based off of seasonality, we get some of the strongest part of the year taking place. So although there's a lot of fear in the markets right now, understand if we are going to follow seasonality's script, we need to pay close attention to more middle of March and into April. And if we do start seeing some rallies take place in individual stocks and individual sectors, we want to be a part of that. Okay, so based off of seasonality, like I said, looking pretty good. Opportunity awaits, but as it stands right now, if we look at the safety trade, which basically looks at gold, utilities, consumer staples, bonds, defensive names, and XLV, which is healthcare, they are the top performers in 2022. You can see on a relative strength line to the S&P 500, each one of these sectors that are considered quote-unquote defensive are outperforming the S&P 500. But overall, the S&P 500 is doing mildly good, trying to hold itself up. But we'll talk about that here soon. Something that does concern me is looking at the NYSE advanced decline line. And the advanced decline line broke down right here a while back, and yet the market itself, the New York Stock Exchange in absolute format here, has not broken down from that line, but it's back right down there at around that 16,000. You can see it's been holding as support. And you can see here, the more times that it's tested, chances are it could eventually break. And I've been talking about this breakdown previously, that might have been some insight that we could very well break down from there. So it is something to watch overall, that it's telling me that the internals have been consistently getting weaker. Now, if you stay to the end of the episode, by the way, in the conclusion section, I'm going to show you a couple of charts, and one is going to be how you can potentially time the market using just a couple of moving averages. Now, what else took place in these last couple of days? Well, the 10-year yield fell off a cliff once again, down 7.18%. So closing at, now the 10-year yield's at 1.7. Wow, that's a big fall after this dropping off of this this rising wedge here. Now, we are looking at the weekly time frame for the TNX, and this could very well just be a back test of this trend line that it recently broke out of. So that is something to pay attention to, as it's already making an aggressive move to the downside in just 2 trading sessions. TLT is continually breaking out to the upside of this wedge that we pointed out. Where can we potentially go to? Well, look how it ran into resistance right here. And if you look to the left-hand side, there's that volume shelf profile that we previously discussed in other videos. So if we start getting above that, it can potentially take us up even further to around 148. So TLT, bonds, SHY, something like that, I'm looking to buy those on specific dips. As far as the dollar goes, the dollar was up on the day too. Now, there has been a really good inverse correlation between the dollar and the S&P 500. So when this drops, the dollar, you see the S&P 500 rise. When the dollar rises, bam, the S&P 500 takes a little bit of a nosedive. So if you are bullish the dollar and you think that the dollar is going to move higher and higher at a rapid rate of change, understand that could very well continue to push pressure on equity markets where we are already in some lower highs and lower lows, okay? So as the dollar puts in higher highs and higher lows, that might continue to put that pressure on there. Meanwhile, what's interesting is even though the dollar's up, look at the day that gold had, up 2.27%. And I am understanding of all the geopolitical risks at play. And if those dissipate, it's going to be interesting to see if gold can continue to hold these levels, as well as some of these other commodities. So gold was up massively on the day. The dollar was up. Silver was up 4.82%, reclaiming that 200-day moving average and having a very solid, nice green candle on the day. So that is a very positive sign overall. Meanwhile, if you take a look at the Fed fund rates, what are they going to do in this environment? Well, the probabilities have significantly adjusted. You can see here, now it's only 3.7% probabilities of a 50 pip hike. And now we're looking really at a 0.25 hike with almost a 100% possibility of that. We'll see here if they're going to surprise us with the 50 or if they might surprise us with none whatsoever. As far as the markets are concerned, Wall Street's pricing is a 0.25 hike come the Fed meeting here. That is right around the corner. Let's take a look at Bitcoin, which is on everybody's mind right now because of these crazy moves these previous trading days. I wanted to call out that we are bumping slightly into this area of resistance. The trend line down here has been holding nicely as support, and we'll see if it can start breaking up. I do like how it's back above these key moving averages right here. That's the 50 and 20, still below that 200-day, right? So maybe if we do get a breakout, we are trying to get a stronger move. That would have been already aggressive move, so we might come back to back test, right? Run into the 200 back test, and then maybe potentially try to break out even higher on the bullish case scenario. I do like how it is outperforming the S&P 500 again, back above that 50 EMA. Ethereum, on the other hand, is not performing nearly as strong as Bitcoin. You can see it hasn't tested its upper trend line and it hasn't got it back above its 50 EMA. That might be in the cards here soon. So we will check back and continue to see if that is the case, but it is holding its support right down here, and this is still an area of resistance to be focused on. Many people have asked me about the Sailor to Shift tool. Has it flipped on, right? People are getting anxious, especially on a move like this. People want to be a part of it. And as it stands right now, no, we haven't actually flipped to a buy signal yet. So that is a little concerning. Now, keep in mind, I always tell people this. This is just a tool. I have a strategy that I use with this tool. You also can have a strategy that you use with this tool. By no way is it a holy grail. I use it because I want to catch the larger moves and protect myself from the downside. So the last buy signal was this right here, and it whipsawed me out right away to a sell signal. Okay, so that ended up being flat. Now, that was my only trade so far with Bitcoin this year. So right now I am, basically at 0% year to date on my Bitcoin portfolio. Meanwhile, Bitcoin is still slightly down on the year. So if I get a buy signal, right, and it not just flips over, but also the next week has to get taken out. If that is the case, I'll catch the move up if Bitcoin wants to start going, super positive. But then I'm going to continue to watch for the next sell signal as well. That's how I plan on playing it. But as it stands right now, I'm just on the sidelines, just patiently waiting. I don't give it too much thought other than that. If we take a look at all the S&P 500 here, we are looking at a heat map, and you can see right across the board, especially those big tech names. Now, the big tech names, when you see these big tech names fall, which we talked about in yesterday's video, that puts pressure on the S&P 500 as well as the Qs. But when you get these to fall, and then you have financials here just getting obliterated, you can see JPM, that put in a new 52-week low, I believe, down 3.7%. Wells Fargo down 5.77%, right? Why is that? Well, the 10-year yield dropped off of a cliff, and that puts pressure on the financials, okay? So the only really green stuff that we saw here today continues to be energy, and you can see that by looking at a list of 52-week highs. So you can screenshot this if you want, a list of, hey, what are the new 52-week highs? What are the strong stocks? Clearly, you can see, no surprise there, energy, and we're starting to get some basic materials up there as well. Freeport McMoran, which is copper, and then you have some industrial names, right? RTX. I'm actually trying to look for another one in here. Maybe it's on the next page over. Lockheed Martin. Maybe I'm just overlooking it right now, or maybe it just didn't make a 52-week new high. I could have sworn that it did. Maybe it's on the next page and I just didn't catch it. But there, as you can see, clearly just a lot of energy names overall breaking to these new 52-week highs. Now, if we take a look at the 11 sectors that make up the S&P 500, for the daily performance, everything was in the red. Financials was the big laggard of the day, right? Why? Well, the 10-year yield was down. Now, this is where it gets confusing for people, is if the 10-year yield starts falling, that should be good for tech, right? Well, it wasn't today. And that right there, probably could be pretty confusing. And the thing is, as it stands right now, we've had a lot of tech stocks consistently put in lower highs and lower lows. And we're coming into a cycle, right, where we are looking at tightening, right? The Fed is going to tighten in to this loose monetary policy, so it's going to be less accommodative. And the thing is, with growth stocks, that's not a great environment to be in. So even though you see the 10-year yield falling and tech not really catching much of a bid, that could be potentially why. Now, that correlation could potentially go back, right? And it could change. But just be very cautious here that tech, including Apple, has been getting hit hard. So we're starting to see this rotation more into defensive, more into cyclical type sectors. All right, before we get into the risk ranges really quickly, I want to let everyone know about my Patreon group. I charge $9 a month, or you can buy it annually, which gives you a 16% discount. It ends up being like $90 and you get it for the entire year. I try to keep it pretty chill and just try to provide as much value as I can. We have a great community and you'll have access to the private discords. You get the weekly watch list. And I'm going to be giving that in Excel and PDF format. That's brand new. And then I give some swing trade setups and ideas along with some general support. So if you want to come be part of that community, come on in. Let's go ahead and get into the risk ranges now. So we have the S&P 500. Actually, today put in a lower high and a lower low today. I was thinking that we could reach a little bit higher, but guess what? We broke that small little trend. Now, overall, is this very bearish type move? I don't think it is. After coming from a move from way down here, right, and then we have a follow-through day, and now we're kind of trending sideways, which kind of talked about. It could be potentially going into a flag formation. I don't think that this is all too bearish. I think we just need to be patient here and give it some more time, because after a move like this, it needs to be digested. Now, if we start taking out this low, that would be obviously a lot more concerning, but we're far from that. And what could potentially make that happen? Well, it would have to be some more geopolitical risk, some sort of news headline, or the Fed coming in and really surprising us. And then the market just takes it as bad news. Overall, we are still lower highs, right, and lower lows at this particular point in time. We're below the 200-day moving average. So it's not like necessarily a time to just rush into things and try to catch bottoms. Yes, based off of seasonality into the middle of March and into April, we can start to see the market perpetuate higher, or potentially various stocks and sectors that are already strong potentially get even stronger. So that's what we'll be watching out for. As far as the risk range goes, you can see here, we're not too far off from the lower range. So as we put in a lower high and a lower low, hey, maybe perhaps if we get a little bit more weakness, we can reach down that this week. Now, in the futures market, as of right now, it looks like we're getting a subtle gap up. So we'll see here where that might take us. Now, in bear markets, you typically get monster rallies, and it'd be nicer to see is actually a gap down, and then we go green on the day. But we'll see here what takes place come tomorrow. But if we take a look at the 15-minute time frame, a couple things that I want to call out here. So you can see we're coming in to a flattening 5-period moving average, right? It's going pretty much just sideways right here. That is not that bearish of a development. So overall, it's trending down, but it's starting to flatten out. That's positive. The reason why it's flattening out is because we got above it. Now it's pulling back down. Okay, we're back right around that lower risk range here, and I want to call the possibility of this being a pennant pattern, a little flag or a falling wedge right here. Because if we do start breaking out, it could perpetuate some more momentum to the upside. Now, understand where we are in context. We are in this volatility zone where we just see massive swings back and forth. So understand, we're just not kind of out of the woods yet. I think it's possible that if we start moving up, we can eventually close this gap and potentially close this one. As far as closing this one this next week or this week, that'd be pretty dang crazy if we can get all the way up there in just a few more trading days. I've seen crazier stuff, but it's something to keep an eye on. What can get us up there? Well, if you take a look here, we had support, then resistance and resistance. This could very well be somewhat of a head and shoulders type pattern that's forming on the lower time frame. So if you were really to measure this as a inverse head and shoulders, and it breaks out, that could very well take us up to here, even potentially a little bit higher to fill that gap. So that is from more of a bullish case scenario that we should be at least mindful of at this particular point in time. If we take a look at the Qs, still lower highs, lower lows. You can see right here, actually, maybe a trend line to watch that I didn't quite draw in. But if you just connect them like that, you know, that might perpetuate us more further to the upside right here, but we're still below a declining 50-day moving average. We're going to start getting a lot of news headlines soon here about the death cross. There was a death cross on the Qs, which is, you know, don't put too much weight on it and don't give, you know, too much weight to its name. It's not a bullish bullish thing at all. It is bearish, right? You don't want these 50-period moving averages crossing under the 200 because it does change trend. But we've seen that happen before where it gets corrected, you know, pretty quickly for the most part. As it stands right now, we are just in this volatility box here, pinging back and forth. And if you look at the 15-minute time frame, you can see it a little bit more clear. A lot of volatility, a lot of volatility. We got out of it. We came right back in it. We got out of it. We came right back in it. So there is a possibility as we're above that 5-day moving average, this could be a bull flag, falling wedge, whatever you want to call it. And if we start cracking out to the upside, bam, that can potentially take us back up to the upper range. And if you want to look at this as possibility for that inverse head and shoulders, which this one's a little bit more rough, it could still very well take us back up to this gap too as well from a bullish perspective, okay? All right, so let's continue on. We're going to look at the Q. So this is actually an important one to watch. I think that we can very well do a lot better in the markets, but you don't want to see this double bottom taken out in small caps, right? So if small caps continue to do good or hold up at these levels, that's going to be a good sign. But if this gets taken out, that means that there could be further downside, obviously, in the market. So that is one very important level to look. I don't think that we're going to get down there this week, right? That'd be way outside of the risk range. What took us outside of the risk range last time? Well, it was the news of the invasion. Now the invasion's already happening, so there can be potentially more peace talks. There could be some positive developments kind of just coming out of that, but we don't know yet. There could be worse developments coming out of it too, which could perpetuate it to the downside too. So just understand you're just in a news headline type driven market right now. From a bearish perspective, we're still below that 50 RSI right there. If we start getting back above it, that would be a good sign. We're not too far off the lower risk range as well right now, and we're back below all those key moving averages. We did put in a lower high and a lower low. So if we start reaching down, potentially, you know, just keep in mind where we are for the week. So if we get down there tomorrow, we might bounce. But as it stands right now, really, we're just coming off of a huge move, right, with some big volume on the double bottom, and now we're starting to go sideways right now. So there's really, it's not bearish, it's just patience that is required. If you take a look at the 15-minute time frame, very similar to the other indices, potentially falling wedge or flagging right here, okay? We're above that 5-day moving average. The 5-day moving is not neutral as it stands, right? It's just going sideways, and we're just sitting inside the just the box of volatility right here, just pinging around, okay? So really, as it stands right now, you need to be just aggressive on some profit taking intraday, and you got to be focused on these ranges here. So if we do start breaking out, that can take us right up to the top of the range. Where's 210? 210 is actually where the IWM broke down from. So there's probably a lot of resistance up in that area as it stands, okay? Now let's just kind of hop into the conclusions. We went over the risk ranges. We went over some very interesting developments. This is the timer that I said you can potentially use. This is using just 3 EMAs, the 5, 10, 20. And it's basically very short term to an intermediate term, 20 being the intermediate term, 10 and 5 being the short. And really what you want to see is the moving averages stack on top of each other. So you want the 5 on top of the 10 and on that, all those on top of the 20. And what that looks like is right here, right? So you have the 5, the 10, and the 20. They're all spread out and they start moving up. And you can see here when they crossed over, that gave us a move to the upside. When they cross all down with one another, right, then it gives us that a bearish sign, buy sign right here, and it moves up. And then really what you want to do is just wait for that confirmation. As it stands right now, the 20 is above the 10 and the 10 is above the 5. So clearly a lot more work has to be done. So as soon as these start getting tighter and potentially look like they're going to have a crossover where the 5 gets above the 10 and above the 20, that could be a bullish development taking place. And on the flip side of that, like look at when, if you're looking for bearish signs, when the 5 gets below the 10, which gets below the 20, that right there gave us some insight that we could see some further downside movements, and we actually haven't had them cross all up on one another since this bearish crossover here. Okay, so let's keep that in our back pockets. It's not a holy grail by any means. It's a very short-term, way to time trends, and as it stands right now, we're still remaining bearish. Now, when could we potentially flip? Well, this right here is the buy and sell signal that I like to use. It's the CPC, smooth over a 10-period moving average. It just recently updated, and typically when you get it way above 1, that's pretty bearish right there. But what I look for as far as a buy signal goes is when it's above 1 and it crosses down through 0.95. Today's reading on the CPC was a 0.89, which is actually not that bearish of a reading, but understand where the 10-period moving average is. It's still above 0.95 level. So if we get that to cross down below 0.95, let me show you what really takes place on at least the last couple of times. So right here it did it, and that gave us the insight into the Santa Claus rally, that big move in October of last year. Bam, we saw that move. Right here, actually, in November of 2020, it actually missed this bottom, but it did end up catching a stronger move there. And then we saw one right here as well that kind of moved a little bit higher. And then we saw one right here that also moved just a little bit higher too as well. So it's not by any means a holy grail, but it could give us insight that a trend could be kind of changing. And then we can picture that, or we can mirror this one with this. So if the moving average is starting to tighten up, if the CPC put to call ratio 10-period moving average starts getting below 0.95, that might indicate that, hey, in the middle of the March into April, we might get that rally that we need to be prepared for. All right, everybody, hope that helps out in today's episode. Have a wonderful night.